The global economy is in danger, and that's bad news for stocks. I'm your host, Steven Van Metre, and thanks for joining me today as the global economy is slowing down and perhaps explains why stocks are headed down. Let's head over to the Wall Street Journal where we picked this story up as the Omicron slows the global economy, hitting the U.S. particularly hard. The U.S. saw a pullback in services and manufacturing growth, while services sector in Europe and Asia also slowed. The pullback was particularly pronounced in the U.S., where both services and manufacturing sectors reported slower growth, according to surveys by data firm IHS Markit conducted in the first weeks of January and released on Monday. The U.S. services and manufacturing sector suffered from supply issues and labor shortages attributed to the surge in cases from the Omicron variant, and high rates of staff turnover resulted in the first decline in overall employment among manufacturers since July 2020, according to the survey. And much of the economic impact comes from COVID-related staff absences, according to Simon McAdam, the senior global economist at Capital Economics, said in a note to his clients. That is a change from earlier waves of the pandemic when government restrictions drove a slowdown in output. Quote, "We think the economic hit will prove short-lived and will be mostly made up for in the months said." Well, Simon, I hope you're right, but I have a hunch you're not going to be, because what we're seeing is potential risks of the global economy heading back into recession. And here you can see the relationship from this chart between the IHS Markit Composite PMI and the U.S. GDP. And as the both manufacturing and services sectors slow down and potentially contract, well, that suggests that the U.S. economy is headed down, and with that, will take the world with it. Let's take a look at where some of these preliminary PMIs are going around the world. And just so you remember, the way you read these is a 50 is unchanged from the month before. Over 50 denotes an expansion. Below 50 is a contraction. And let's start out with Japan, where we see the manufacturing sector expanded is, again, preliminary, believed to be expanding at the same rate as it did in December, while the services sector is indicating it's contracting from the month before, and that's not good for Japan. Let's go over to the Eurozone, where we see the manufacturing PMI potentially expanding at the same rate as December, and that's good. You see a nice strong 59 from the Eurozone, but note the services sector, which is already showing weak growth in December at 53, is now marginally and only very slightly expanding to 51.2, at least based on the current data for January. And likely, I expect those numbers are going to come down. Let's take a look at Great Britain, probably the best story here out of them all. The manufacturing sector expanding at about the same rate as it did last month, and the services sector, while not putting up big numbers, it's still expanding at least at the same rate it was the month before. Let's go on to the U.S., where we start to see a slowdown in the manufacturing sector, as the Wall Street Journal pointed out, dropping from 57.7 to 55, showing the manufacturing sector is still expanding, just not quite as fast of a rate before. But look at the services sector, went from a brisk 57.6 to almost marginally expanding in January, showing that virtually no change in the rate of growth for January for the U.S. And that, of course, is part of the issue here, as we see a slowdown in the market data tells us that a recession could be coming much sooner than most expect. And that may explain why the stock market's headed down. But if you're invested, you shouldn't be seeing your portfolio go down near as much, and you wouldn't if you were in Portfolio Shield. Be sure to check that out. Now let's look at some other evidence that shows the economy is indeed slowing down. The U.S. Chicago Fed National Activity Index going from a nice 40.44, which is 0, denotes an expansion on trend, to minus 0.15, showing below trend growth. Here we see the chart now falling below the trend for the first time in several months. As we look at the data, a zero value for the CFNAI is associated with the national economy expanding its historical trend, and negative values below average growth. So the Chicago Fed's validating what we're seeing in the market data, perhaps suggesting the market data may be a little optimistic. And how about that inflation story that everyone believes? Well, we can see the 3-month moving average of the CFNAI is sitting somewhere around 0.3. Well, does that mean there's inflation on the horizon? Well, not likely, because what we can see, an increasing likelihood of a period of sustained increasing inflation has historically been associated with the values of the CNFAI moving average of the 3-month above 0.7 for more than 2 years in an economic expansion. And folks, we're not even close to those numbers at all. But why does this perhaps mean the stock market is headed lower? Well, let's look at this last chart, and you can see, because there's a nice relationship with this going on here. Now, I don't have the ability to chart the market data against the equity market, but I do have the ability to chart the gross domestic product. So here you see GDP against the Wilshire 5000, both showing on a percentage change from a year ago. So perhaps the reason the market is headed lower, again, this is percentage change from a year ago, is it's leading the GDP lower because the equity market has figured out that the U.S. economy is slowing down. And what that means, the stock prices also need to come down from their lofty levels. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video provides educational information only. It's not intended to provide investor advice. It's not to be construed as recognition or solicitation by selling securities, financial instrument, or participate in any particular trading strategy. This video was spread by Steven Van Metre. Personal capacity, opinions expressed in this video that do not affect the view of Atlas Financial Inc. or Steven Van Metre Financial.